This week we're going to take a look at a couple exercises from chapter 20, and we're focusing on master budget. So we're going to take a look first of all at production budget. And for the operations folks, for the folks making production of these goods, they're going to want to look ahead to see what the marketing department is forecasting in terms of sales. And the reason for this is whether or not we are in procurement division or an operations division, we are going to have materials that we're going to either begin with, those that likely came out of inventory, or goods that we're going to manufacture or procure during that period of time. And everything that's going to be available is going to go one of two places. Either it's going back into storage or back into inventory, or it's going to get used in that period. So in terms of what we're going to use and what we're going to use in terms of the current period and what we're going to need to put into storage to save for the next period is going to come based on that forecast from the marketing department in this case. So we're going to start in April, and for what we're going to need to save into inventory, what we're going to budget for what we're putting back into that inventory, is we're going to look ahead and see what we're going to need to make for May. And you can see from the problem, the rule we have for our operations department is we're going to save 25% of next month's sales, put into inventory to get us essentially a head start on production for the following month. That way there's no disruptions in our supply chain or in our manufacturing process rather. So we're going to need to know what that forecast is. So here we start with 580. We're going to take 25% of that. To get 145 is what we are going to budget to be wanting to put into inventory. And we're going to need to know what we're going to use during the period as well. So we're budgeting 500 units is what we're going to use for April. So we're going to have a total of 645 units that need to be available in April to either go into storage, that being 145 of the units, or to get used in that current period, that being 500. Of the 645, it's got to come from one of two places. Either we're going to be producing it in the period, or we're going to begin with it. And here we know that we began with 125 units, and we know that from the problem as well. So we will subtract that from the 645 to get us 520 units is what we're going to budget for production in April. And then we're going to do something similar for May and June, to where in May we're looking ahead to June's sales, taking 25%. May's sales being that 580, so we'll get 715 total for the month. And then we're going to subtract the 145 that we began the month with. And you can see that that beginning inventory for May is that calculation for what we budgeted from April for the ending inventory. And then once we do that calculation, we'll get 570, and then June will follow in sorts. So we'll look ahead to July for sales. 25% is 155. And then we're going to have budgeted sales in June of 540, and we get that from the forecast as well. And then our 135 that was ending inventory for May will become beginning inventory in June and leave us with 560 for production budgeted in June. So for the next exercise, we're going to look at the labor and overhead budget. So similar to how production was looking ahead to marketing, we can have procurement doing a direct materials budget, or labor and overhead budget kind of looking ahead to what production is going to be in terms of what we're going to need in terms of labor, what we're going to need in terms of material, and how we're going to budget for that overhead. So here the production budget is going to be 2,400 units during the second quarter, and then we've got some information here for direct labor as well as for the variable and fixed components of overhead. So we're going to start with that 2,400 units in production. This is going to be for our labor budget. The next thing we want to know is how much labor is going to be required per unit. So we know we're budgeting 2,400 units is what we're going to need. And we're going to get that from the problem here, to where it's going to be 4 direct labor hours per unit. So we'd multiply 4 hours per unit times 2,400 units to get 9,600 hours is what we're going to budget. But we're likely going to want to know that information in terms of dollars. So we want to know what the labor rate per hour is going to be, and that's given in the problem as well as $9 per hour. So multiplying $9 per hour times the 9,600 hours we're budgeting would give us a labor budget of $86,400 that we'd be budgeted for. We're going to do something similar here for overhead. Again, we're going to start with the 2,400 units in production, and it's going to take 4 labor hours per unit to produce each item. So 9,600 labor hours is what we were projecting for the period. We allocate our overhead in this problem based on direct labor hours, so we're just going to use that total labor hours budgeted as our starting point here. And for the variable amount, we're going to have $11 per direct labor hour. So we'd multiply 11 times the 9,600 to get 105,600. Now keep in mind that's only the variable overhead for the budget. We're also going to have 460,000 that's going to be what we have for a fixed overhead component. So 450,000 actually for the budgeted fixed overhead. I think it's a typo between the amount, the 460 is listed in the problem, and the amount that's listed here in the guided solution that we're walking through. Those amounts should match, but I think it's just a typo in the top part of the problem here. But we're going to add the fixed budget and get, using the amount here, that's 555,600. Had the 460,000 listed above in the problem been correct, then the correct solution for total budgeted factory overhead would have been 565,600. And we're going to take a look at an exercise in Chapter 21 as well for flexible budgets. And what this is going to take a look at is we're going to project the amount of materials and the amount of labor that we're going to need for production, say. But as we get more information, as we figure out what those costs actually are, we're going to have a different amount. So unless we've got perfect foresight to where we know exactly how many materials we're going to use, how much labor we're going to use, our budget and our forecasts are going to be just that. They're going to be our best estimates of what's going to happen in the future. And then we're going to learn from activities that go on what the actual amounts are going to be. What this type of flexible budgeting is going to help us do is the difference, how much we're off by, also what we're going to refer to as a variance, is going to be broken down either by the price component or by the quantity component. And we're going to be able to isolate where that difference is coming from, or where what we're going to call a variance is coming from. So the first one we're going to take a look at is going to be for direct materials price and quantity. So we are going to set these up, and we're going to have what we are going to have as our initial estimates. We're going to refer to those as standard price and quantity. And then once we learn how much we actually use, we're going to refer to those as actual price and quantity. And the way the text and the way most text will walk through this is going to be left to right, where we go from actual to standard, and we kind of work our way through it. I think it's also useful to think about it going right to left, where if you are estimating the standard prices out, and then you learn about what those actual costs are later in time, it intuitively is going to help you to think through the problem, maybe as a checking the answer by going right to left and kind of seeing how that breaks out. But you're able to do it either way, and the text will take us from the actuals to the standard. So the first thing we're going to compute is going to be our actual cost, and that's going to be actual quantity times actual price. And then we're going to have our standard cost, which is going to be standard quantity times standard price. And then we're going to have this middle amount, which is going to be our actual quantity times our standard price. And we're going to do that just to isolate what portion is coming from the price being different and what portion is coming from the quantity being different. So we're going to go ahead and start populating this with numbers. Our actual quantity here in terms of direct materials is going to be 138,000 pounds. And the actual price is going to be $3.75 per pound. So that's going to give us $517,500 for a direct materials cost. We're just going to copy the 138,000 over, and we're going to include standard price as $4 per unit. And then that is going to be based on the first column there under standard where it says 15 pounds at $4 per pound. So that's where that's coming from. So and that's going to be 552,000. So the amount that comes from the difference in price, that being saving, if you want to think about it that way, 25% per pound is going to be 34,500, and that's going to be considered a favorable variance because we had a smaller amount of actual cost than what was forecasted using that calculation. Now if we look at our standard cost here, 135,000, and that's computed by taking 9,000 units from the problem times the 15 pounds per unit, which is under the standard column. We'll get 134,000 is going to be the estimated pounds that we're going to have for a standard quantity, and then we're going to have $4 for that standard price, which will get us 540,000 for direct materials, and that's going to be a 12,000 unfavorable variance. So here we estimated 135,000 of materials, and we actually used 138,000 of materials. So the $12,000 cost difference is going to be something that did not go in our favor, that was more costly to us, and we're going to have an aggregate variance that's going to be 22,500. So we're going to have 34,500 of favorable, and then less 12,000 of unfavorable. It's going to be a net amount of 22,500 favorable, and that's also, if you notice, the difference between 517,500 on the far left of this illustration, and the 540,000 on the far right of the illustration. Now the favorable and unfavorable amounts are going to be basic on computation strictly. So you could say that, hey, we use more materials in our goods, so they're probably going to be better quality or something like that, but that's not the way the calculation works. So think about the additional material being used as additional scrap or additional waste in the process. And similarly, you may think of the amount paid for the goods. You might get cheaper goods, but think about them in terms of being the same apples-to-apples comparison for a good. So if you save 25 cents per pound on the exact same item, you would consider it favorable. Now for labor, we're going to change the terminology, but I'd encourage you to think about this as it's the exact same illustration. It's going to be the exact same process. Similarly, I think it makes a lot of sense to go from right to left, thinking about having your estimates of your standard cost, and then you learn maybe some information in terms of how much you use in the process, and then you learn a little bit in terms of what the price actually was. The only difference here is we're going to change what we call the price. For example, we're going to refer to it as a rate, and that we're going to change, instead of calling it a quantity variance, we're going to call it an efficiency variance. So we're going to have the same concept that gets played out here for labor. The only real difference is instead of referring to it as price like we did with direct materials, direct labor, we're going to refer to it as a rate. And for the variance here for the amount, instead of referring to it as a quantity, we're going to refer to it as an efficiency. So we're going to have an actual, the actual number of hours and the actual rate. And we're going to have the standard number of hours and the standard rate. And then we're going to have our actual hours times our standard rate. So here we're going to take 31,000 of actual hours, which is from the second column, and $15.10, which is also from the second column. Multiply those together to get 468,100. We're going to copy that 31,000 over directly, and then we're going to have a standard rate of $15 per hour that's in that first column. So that would give us 465,000. And because we spent more money for solely based on the rates, we're going to consider that $3,100 difference as an unfavorable variance. So for the standard hours, we're going to take 27,000. We're going to calculate that by the 9,000 units from the top portion of the problem, and the 3 hours per unit that's listed in that first column, which would get 27,000 direct labor hours is what we would project, times the $15 standard rate. We'd get 405,000 for the standard cost that we would budget. And we're going to take the amount that differs between the 465,000 and 405,000 to get 60,000. That's an unfavorable variance due to what we're going to refer to as an efficiency. So we're going to spend 4,000 more hours than what we budgeted for, and that's going to result in 60,000 additional cost. And that's calculated by the 4,000 additional hours times that $15 per hour. And then we also have that 3,100 additional amount based on the 10 cents per hour difference between the actual and the standard rate. And then here, because both are unfavorable, we're going to have a combined amount of 63,100. That's going to be the total unfavorable labor variance that we're calculating. And again, you'll note that that's going to be the difference between the 468,100 and the 405,000. So the amount on the far left of the illustration and the amount on the far right is going to be that total variance that we're going to have here.